So joining me now to break it all down are Boom Bust co-host Christy I and Michelle Snyder, partner and director of trading research and education for the Market Gauge Group. Michelle, let's start with you here, and let's talk about this news of a global minimum tax on corporations. What do you make of it, and do you think that this sort of large-scale international cooperation will work out and will actually be successfully implemented?
Well, both very good questions, Rachel. So let's just put a little bit of complexion on there first. So as you said earlier, this is a 15% global tax rate that was introduced at G7. It was also very much endorsed by Janet Yellen because she said up until this point we've had a race to the bottom in terms of corporations paying at least amount of tax, and then they were basically setting up tax havens in countries that had 0% tax rates like Ireland and the BVI's and the Cayman Islands. So the whole intention of this is to be able to tax these large corporations on where they do business and not where they actually are headquartered. So idealistically, the whole point is to give a competitive edge to some of these smaller corporations and the middleman, so to speak, to be able to actually have some advantage in terms of the globalization, just like the mega rich have had, which essentially have been high profits and very low tax rates. If that's the case, if we can actually have an evolution where an e-commerce and small businesses can actually become more competitive to the larger corporations because of this, fabulous. Can it actually be pulled off? Well, you had 130 of 137 countries saying yes, so it's hopeful that not only does it get pulled off, but that it actually has the desired impact to help the smaller guy and not necessarily find corporations with new loopholes that they can do to sort of avoid the taxes once again.
Yeah, it always comes back to those loopholes at the end of the day, and those large corporations always seem to find them. Now, Christy, we're seeing prices rising all around, inflation headwinds are growing, and now officials are debating if this is going to be transient or persistent. So what's the latest there?
Well, it seems like the Fed officials are now less in sync when it comes to inflation. So they're being increasingly divided on how to think about and react to the emerging risks after now that we've had several months of rising asset prices and rising commodity prices. So one half of the camp still maintains that the recent price surge will fade as the economy reopens, but the other half of the camp is warning that it will be persistent and that we are at risk of overheating. So Fed Chair Jerome Powell acknowledged that a permanent period of uncomfortably high inflation is a possibility, but he said it's more likely that the recent price hike will fade. And again, this all sounds like reassurances to the market because other officials have expressed further concerns that these prices could continue to rise and the Fed may need to slow down its support for the economy. So at the beginning of the year, this persistent inflation seemed like a very fringe possibility, but now it's becoming this central feature of the economic policy debate as the price of things like used cars, airline tickets, and restaurants, food, and everything basically soars. Base commodity prices have increased a couple folds, driving up manufacturing costs. So right now the Fed is kind of stuck. They said they wanted to achieve a, quote, considerable further progress towards their goal of a full employment before slowing down purchases and tapering off. But the reality is that the country is overheating while we're still short about 7.6 million jobs, while the prices and assets have risen much faster than expected. So published forecasts right now from the Fed suggest that the policymaking committee is sharply divided on when the liftoff will actually occur. 5 expect that rates will remain unchanged until the end of 2023. 2 see an increase at the end of the year. 3 see 2 increases. 3 see 3 to 4 increases, etc. So it's really all over the place. So at the end of the day, it really doesn't seem like anyone knows where this is going.
Yeah, and that's actually been one of the most interesting developments from the Federal Reserve is finding out just how far apart some of these officials are on what their expectations are for the rest of this year. Now, Michelle, we're also learning that CFOs of corporate America in a recent survey expressed little confidence in the Fed's abilities to control inflation. So how will the wage pressure in the labor market and more inflationary pressures affect corporates moving forward?
Well, before I answer that, I just have to say, listening to Christy and then part of your question, I almost am reminded of Gulliver's Travels when the Lilliputians trying to decide which side they should crack the egg on and go into war over that. But besides that, so yeah, I mean, as Christy just said, the costs are rising everywhere in packaging, raw materials, shipping, labor, and we've had a 3% growth in the wages, which is the largest that we've had since 1990, and many economists are expecting another 3% growth in the second quarter. So what will that do? Well, first of all, wages have been generally way behind in terms of productivity and profitability. So there is some room for those wages to go up. But in the long run, as we know, particularly as we're talking about inflation and these rising costs, that also rising wages can be not only inflationary, it can eat into the bottom line of some of these corporate profits. So for now, we have great hiring spree. We have incentives all over the place to get back to work, but we're still seeing shortages. And hopefully at some point it normalizes. But I think the whole thing is just another piece of the puzzle in terms of the inflationary pressures that we're about to see, which should keep those Fed members fighting over which side of the egg to crack.
Right. Now that they're getting input from corporate America, of course, they're taking that very seriously. Now, Christy, before we go, I also want to talk about this OPEC Plus meeting where they're discussing bringing in more supply online. Now, U.S. crude oil prices have topped $75 a barrel, the highest since 2018. So will the extra supply alleviate this?
Not really, because it's expected that OPEC Plus will actually move very slowly in adding about 2 million barrels per day to the oil markets from August through December, because the group plans to just ease back into things rather than flood the market and actually alleviate the shortage. And many traders and investors, they had expected a bigger output rise in August, especially with prices where they are at now. But unfortunately, it looks like they will have to keep the market very, very tight this summer, even with the rising demand, because you have to remember that OPEC Plus, they basically didn't really make much money last year as demand for oil was pretty much non-existent due to COVID. So now they're actually motivated to keep prices high for a while in order to replenish their coffers that have been severely strained. So things are going to be quite tight for a while, and we could potentially even see $100 oil prices again.
Excellent points to consider here. Christy I, Michelle Snyder, thank you both for your time.
Thank you, Rachel.